There's a bill sitting in the United States Senate right now that almost nobody trading gold and silver has actually read, and I think that's a mistake, because buried inside it is an admission most people in Washington would rather not say out loud in plain English. The system that decides where your silver actually sits, the vaults that back every futures contract on the largest precious metals exchange on Earth, has a single point of failure, and for the first time in decades, lawmakers from both parties are moving to fix it. You've probably seen the version of this story floating around some corners of the internet lately, the one that claims the Treasury Department has effectively seized control of COMEX, that the old system is finished, that some dramatic government takeover just happened behind closed doors. I want to be straight with you before we go any further. That specific claim isn't accurate, and I'm not going to repeat it to you as fact, just because it makes for a dramatic headline. COMEX is run by CME Group, a publicly traded company, and the Treasury doesn't own it or operate it. But here's the thing, the real story underneath all that noise is genuinely significant, and in some ways it's more interesting than the exaggerated version, because it's happening in plain sight, with real legislation, real testimony, and real data you can go check yourself. So let's actually get into what's true, why it matters, and what it tells you about where gold and silver go from here. Let's start with where prices actually sit today, because context matters before we go anywhere else. Gold is trading right around $4,100 an ounce this morning, silver sitting near $59. Both metals have been sliding lower for the past two trading sessions, as the ceasefire between the United States and Iran has effectively collapsed. Airstrikes have continued for a second straight day, oil prices have jumped, and the Federal Reserve's own June meeting minutes showed policymakers growing more concerned about inflation, with markets now pricing in the possibility of a rate hike before year-end rather than the cut everyone was expecting just a few months ago. If that sounds familiar, it should, because we've talked before about how this exact combination, an oil shock colliding with a hawkish Fed, has been the dominant force pushing gold and silver around this year, far more than any single piece of market structure news. I want you to hold on to that context because it's going to matter when we get to the part of this story that actually is structural rather than just headline-driven. Now here's where the real story begins, and it starts with a number that should genuinely surprise you. Every ounce of gold and silver that gets physically delivered against a COMEX futures contract has to come out of an exchange-approved depository. That's the rule. You can't just show up with your own vault and say it's good enough. The exchange has to certify the facility first, and right now virtually every single one of those approved depositories sits in one place, the New York metropolitan area. Representative Mark Harris said this plainly at a House Agriculture Committee hearing back in April, telling the CFTC directly that the concentration of approved metals depositories around a single city raises real questions about national security, market efficiency, and operational resilience. Think about that for a second. The exchange that sets the reference price for gold and silver used by industry, investors, and central banks worldwide is physically backed by metal sitting almost entirely in one geographic cluster. Have you ever wondered why that would matter? Here's the plain version. When all the eggs sit in one basket, geographically speaking, you've built a system that's vulnerable to exactly the kind of regional disruption that's supposed to be rare but never actually is. A major storm, a grid failure, a transportation bottleneck, a security incident, any single localized event with the bad luck to hit that specific corridor could, in a worst-case scenario, disrupt the delivery mechanism for the entire U.S. futures market in gold and silver simultaneously. And there's a second consequence that's arguably even more relevant to your wallet if you've ever bought physical metal. When only a small cluster of facilities qualifies as exchange-approved, those facilities have essentially no competitive pressure keeping their storage fees in check. According to testimony at that same CFTC hearing, storage costs at the existing approved depositories run at close to the maximum allowable rates because there's nowhere else for institutional money to go if it wants exchange-recognized storage. That's not a conspiracy. That's just what happens when a market has a genuine, well-documented choke point and nobody's gotten around to widening it. This is exactly the vulnerability that a bipartisan group of senators decided to address in May. Senators Jim Risch of Idaho and Catherine Cortez Masto of Nevada introduced what they're calling the Silver Act, officially the System Integrity Through Licensed Vault Expansion and Resilience Act. It's a genuinely simple piece of legislation once you strip away the acronym. It would direct the CFTC to require at least 2 approved precious metals depositories in each of the 4 continental U.S. time zones: Eastern, Central, Mountain, and Pacific. Right now, states like Idaho, Nevada, and Texas, all of which have real precious metals industries and infrastructure, aren't part of that approved network at all. This bill follows companion legislation that was already introduced in the House back in March, and the CFTC's own chairman has publicly endorsed the concept. When you line those pieces up, a House bill in March, a CFTC chairman's endorsement in April, and a bipartisan Senate bill in May, all inside a 60-day window, that's not a coincidence. That's Washington responding to something it's genuinely worried about. And what it's worried about is worth spelling out clearly, because this is where the physical delivery data gets genuinely interesting, and it's backed by real, verifiable exchange reporting rather than speculation. Earlier this year, in January, COMEX experienced a real and heavily documented delivery event in silver. Over roughly 7 days, more than 33 million ounces of silver were physically withdrawn from registered COMEX inventory, which worked out to about a quarter of the entire registered pool disappearing from the exchange's books in a single week. That is an enormous move for a market that spent most of the prior decade barely registering delivery activity worth mentioning. It happened alongside silver's all-time high above $121 an ounce, reached on January 29th. The same week, gold also touched its own record above $5,500, and in the weeks that followed, both metals underwent a dramatic correction. Silver fell roughly 40% from that peak by early April. Gold suffered its worst quarterly decline in over a decade. So here's the honest, nuanced version of what actually happened, because I think this is the part almost nobody explains carefully enough. 2 things were true at the same time this year, and they pulled in opposite directions. On one hand, the physical delivery data genuinely showed real stress. Registered COMEX silver inventory, meaning metal actually pledged and available for delivery rather than simply sitting in storage, fell as low as 13.5% coverage relative to outstanding open interest by early April, a level commodities analysts consider a real stress threshold, not just a talking point. Shanghai spot silver traded at a persistent premium over SOMEX futures, at times approaching 10%, an unusually wide and sustained gap that signals genuine tension between what Asian physical buyers were willing to pay and what New York paper markets were quoting. On the other hand, price itself did the opposite of what a simple squeeze narrative would predict. If paper markets were truly losing control and physical scarcity was the dominant force, you'd expect prices to keep grinding higher even as inventories tighten. Instead, silver fell sharply, and it fell specifically because of monetary policy expectations, not because the physical story reversed. Is that a contradiction? Not really. And understanding why is actually the single most useful thing I can teach you today about how these 2 markets, the physical one and the paper one, actually interact. Physical tightness and price direction are not the same variable, and conflating them is exactly how retail traders get whipsawed in this environment. The delivery data tells you something true and important about structural stress inside the plumbing of the market. The price tells you something different, mainly what leveraged, short-term money is doing in response to interest rate expectations, dollar strength, and geopolitical headlines on any given week. Both of those things can be happening simultaneously, and this year they were. The physical system was genuinely straining under real delivery pressure at the exact same time paper prices were falling because the Fed turned hawkish and the dollar caught a bid. Neither one canceled the other out. They just operated on different clocks. Let's bring this current, because the physical data hasn't stood still since April. By early June, COMEX combined silver stocks had actually grown by nearly 5 million ounces in just 11 trading days, bringing total reported stocks to roughly 319 million ounces. Here's the detail that matters more than the headline number. That growth was concentrated in the registered category specifically, meaning metal actively being designated as available for delivery, while open interest, the paper side of the ledger, stayed roughly flat. In plain terms, real silver was physically moving into deliverable status faster than new paper contracts were being written against it. That's a meaningfully different signal than what we saw back in January and February, when the stress reading initially improved mostly because speculative paper positions were collapsing rather than because fresh physical metal was actually arriving. This time the metal itself showed up. That's the kind of distinction that separates a market genuinely working through its stress from one where the numbers look fine on paper for reasons that don't actually reflect improving fundamentals. Would you call this a trap if you were trading purely off the headline delivery numbers without understanding what's driving them? Honestly, yes. And that's exactly the trap a lot of retail traders fell into earlier this year. Watching that January delivery spike and concluding the paper market was about to break entirely would have led you to expect runaway higher prices. Instead, you got a 40% correction over the following 10 weeks. The lesson isn't that the physical stress wasn't real. It absolutely was, and the data backs that up unambiguously. The lesson is that physical stress and near-term price direction can diverge for extended stretches, and trading on one while ignoring the other is how accounts get liquidated on both sides of this market. Let's talk about the other rumor that keeps circulating, because I promised you I'd separate what's confirmed from what's speculation, and this one matters. There's persistent chatter in the gold community about a potential U.S. Treasury gold revaluation, essentially the idea that Washington could mark its gold reserves up from the statutory book value of $42.22 an ounce, a figure that's been frozen since 1973, to something closer to the current market price. Commodities researchers like Jeffrey Christian at CPM Group have specifically flagged this as a rumor that continues circulating precisely because of what it would mean for the federal government's balance sheet and debt picture, not because there's been any confirmed policy action. I want to be precise here. As of today, that is a rumor being discussed by serious analysts because of its genuine theoretical significance, not a confirmed event. If it ever did happen, the mechanics are meaningful. It would effectively create an enormous one-time paper gain on the government's books without selling a single ounce of actual metal, which is exactly why it keeps coming up in conversations about America's debt trajectory. But treating a discussed possibility as an announced fact is exactly the kind of thing that turns real analysis into misinformation, so I'm not going to do that to you. What isn't a rumor, and what I think deserves far more attention than it's getting, is what central banks are actually doing with their reserves right now, verifiably, every single month. China's central bank reported its largest monthly increase in gold reserves in more than 2.5 years in June. That's not a projection or a rumor, that's a filed number. And it extends a buying streak that's now run for the better part of 2 years, through some of the most volatile pricing this metal has seen in its history, including straight through the worst quarterly decline in over a decade earlier this year. Central banks globally are on pace to add somewhere close to 850 tons to reserves this year, well above the historical average that was normal before Russian dollar reserves were frozen in 2022, an event that fundamentally changed how sovereign reserve managers think about holding assets that another government can freeze with a signature. That is the closest thing to a genuine, ongoing, verified structural force in this entire market, and it's been running quietly in the background this whole time, largely unaffected by whatever the price does on any individual week. Let's get into the chart for a second, because I know a lot of you trade off levels, not just narrative. Gold's near-term picture has been choppy, but the key zones worth watching sit around $4,000 on the downside, a level that's already been tested multiple times this week amid the Iran escalation, and resistance up near 4,200, a level the metal hasn't been able to hold above with conviction since the correction began in earnest back in February. Silver's chart tells a similar consolidation story. After that violent 40% drawdown from the January peak, the metal has spent months carving out a range roughly between $52 and $78, with the 50-day moving average sitting up near 78 acting as a lid on rally attempts. A confirmed break above that zone on real volume would be a meaningfully different technical picture than what we've seen since the correction began. On the downside, if the low 50s give way, chartists watching this closely have flagged 54 as the next real support level. I'm not telling you which of those outcomes plays out first. I'm telling you both remain genuinely on the table, and that uncertainty is exactly why positioning in this market has felt so difficult for anyone trying to trade the short-term swings rather than the multi-year structural story. I want to spend a minute on silver specifically, because I think it's been somewhat overshadowed by gold in most of the coverage this year, even though arguably it's the more interesting metal from a pure supply and demand standpoint. The Silver Institute is projecting a sixth consecutive annual global market deficit this year, meaning the world is consuming more silver than mining and recycling combined can supply for the sixth year running. That persistent deficit is being driven by a genuinely diverse set of demand sources now, not just jewelry and traditional investment. Data center build-out, electric vehicle production, and solar panel manufacturing have all become meaningful, growing sources of industrial silver demand, and the Silver Institute's own survey work projects physical investment demand alone rising a further 20% this year to a 3-year high. That's the deficit math that underpins the more optimistic long-term silver forecasts you've probably seen floating around, with institutions like Bank of America publishing bull case scenarios well above $100 an ounce based on historical relationships between gold and silver pricing. I treat those upper bound forecasts with real skepticism given how wide the range of professional estimates actually is, anywhere from the low 80s to well over $200 depending on which desk you're reading, which tells you plainly that even the professionals covering this market for a living don't have a confident consensus on where price actually lands this year. Here's a historical parallel worth sitting with, because I think it explains why Washington is finally moving on volt concentration now rather than 5 or 10 years ago when the same theoretical risk existed. Market structure reform in commodities markets has a well-established pattern. It tends to happen after a genuine stress event exposes a vulnerability that was previously treated as a hypothetical. The January delivery spike, the Bank of England's own documented struggles with London gold delivery delays earlier in this cycle, and the widening physical premiums between COMEX, LBMA, and Shanghai all did the same thing this time around. They took a risk that market structure specialists have quietly flagged for years: the concentration of approved depositories around a single metropolitan region, and turned it into something concrete enough that a bipartisan group of senators felt the political need to actually legislate around it. That's the value of paying attention to unglamorous infrastructure stories like this one instead of only the price headlines. By the time a genuine structural vulnerability shows up as a Bloomberg headline, it's usually already been building for years underneath the surface, because I think the honest picture is more useful to you than either extreme version circulating online. The old system isn't over, and no single event this year, not the January delivery spike, not the Silver Act, not gold's brief run to an all-time high, has actually broken the mechanism connecting COMEX futures, London spot pricing, and physical delivery. What has happened is more incremental and, frankly, more durable. Lawmakers are responding with real legislation to a genuine, well-documented concentration risk in how this market is physically backed. The delivery data through the first half of this year shows real, measurable stress that eased and then partially resolved through actual physical metal arriving rather than just paper contracts unwinding. And underneath all of that, central banks have kept adding to reserves every single month regardless of what price does, which remains the single most consistent, verifiable signal in this entire market. Is this rally sustainable, some of you are asking, now that both metals have pulled back meaningfully from their January peaks? I think the fair answer is that it depends entirely on which version of this rally you mean. If you're asking whether the specific move from November through January, the one that took gold above 5,500 and silver above 120, was sustainable at that pace, the market has already answered that question with a 40% silver correction and gold's worst quarter in over a decade. If you're asking whether the multi-year structural forces, central bank accumulation, de-dollarization, a physically strained but not broken delivery system, are still intact, the evidence says yes, and none of that has reversed even as short-term price action has been genuinely brutal in both directions. If you're someone who wants clear, research-based breakdowns of what's actually happening in these markets, instead of headlines engineered purely to get you to click, that's exactly the kind of channel I'm trying to build here. So make sure you're subscribed, because we're going to keep tracking this legislation and this delivery data as it develops in the months ahead. There's a psychology piece worth naming plainly here, because it explains why the exaggerated version of this story spread so much faster than the accurate one. A claim like Treasury just took control of COMEX is simple, dramatic, and gives you a clear villain and a clean resolution in a single sentence. The real story, a bipartisan infrastructure bill working through committee, delivery data that shows genuine stress easing through actual physical replenishment, rather than a dramatic government seizure, is slower, messier, and frankly less satisfying to read in 15 seconds on a phone screen. That doesn't make it less important. If anything, the unglamorous version is usually the one that actually moves markets over a multi-year horizon, while the dramatic version burns through the news cycle in a week and leaves anyone who traded on it holding a position built on something that never actually happened. I'd rather you understand the slower, real version and adjust your expectations accordingly than get swept up in a headline that collapses the first time someone actually checks CME Group's ownership structure. Let's touch on the dollar for a moment too, because it's the piece connecting the geopolitical headlines to the metals price action more directly than almost anything else this week. The dollar index has been climbing as the Iran situation escalates, which is the classic short-term reaction, capital flowing into the currency itself as a safe haven, even while it also flows into gold for the same underlying reason. That's a dynamic worth understanding rather than treating as a contradiction. Gold and the dollar can both catch safe haven bids simultaneously during a genuine geopolitical shock, even though over longer stretches they typically move in opposite directions. What tends to happen next, historically, is that once the acute shock either resolves or gets priced in, the dollar's safe haven premium tends to fade faster than gold's does, because gold carries the added structural tailwind of central bank accumulation and de-dollarization that the dollar itself obviously doesn't benefit from. That's part of why so many analysts are watching this Iran situation less for its direct price impact this week and more for what it does to Fed policy expectations over the next several months, since that's the channel that tends to have the more durable effect on where gold and silver actually settle once the immediate headlines fade. Let's talk about what to actually watch from here, because that's more useful than speculating about outcomes nobody can confirm yet. Watch whether the Silver Act actually moves through committee and gets a floor vote, because bipartisan bills addressing infrastructure concerns like this one do sometimes stall for years, even with initial momentum. And the difference between a bill that passes and one that dies in committee tells you a great deal about how seriously Washington ultimately treats this vulnerability. Watch the monthly COMEX delivery reports specifically for whether registered inventory growth continues to come from genuine physical inflows rather than paper open interest simply shrinking, because that distinction is the difference between a market healing and a market that just looks calmer on the surface. And watch the central bank purchase data every single month, because if that buying ever actually slows or reverses, that would be a far more significant signal about this market's underlying health than any single delivery report or piece of pending legislation. Do you think smart money is already positioning itself around this vault concentration risk? Or is this legislation mostly symbolic until an actual disruption forces the issue? I genuinely want your take in the comments, because this is exactly the kind of story where informed disagreement teaches all of us more than everyone simply agreeing with whatever headline they saw first. And if this kind of grounded, fact-checked breakdown is useful to you, take a moment to like the video and share it with anyone who's been repeating the more dramatic version of this story without actually knowing what's real and what isn't, because separating those two things is exactly the service that's missing from most of the coverage on this topic right now. Here's the honest takeaway from everything we've covered today. Nobody seized COMEX, and the old system isn't over, whatever the more sensational corners of the internet want you to believe. What is genuinely happening is quieter and, in its own way, more consequential. A real vulnerability in America's precious metals delivery infrastructure has been documented in congressional testimony, addressed with real bipartisan legislation, and stress-tested by actual delivery data earlier this year that showed both real strain and, more recently, real signs of physical replenishment. Layer that alongside central banks adding to reserves every single month without pause, and you get a market that's genuinely changing shape underneath the surface, just not in the dramatic single headline way it's being sold to you. I'll keep tracking every piece of this as it develops, and I'll see you in the next one.